I'm thrilled to have you here for this webinar. We'll be diving deep into some powerful strategies for real estate investors. Property investors, today you have the chance to make a big decision that could have a significant impact on your future. It's not about just buying and renting out the properties. It's about optimizing your cash flow, minimizing your tax liabilities, and ensuring that your investments are working as hard for you as possible. Whether you're just starting out or you're a seasoned investor, understanding the best financial strategies can help you maximize your returns, minimize your liabilities, and achieve your long-term wealth goals. Let me introduce myself and my colleague, Stéphane. My name is Martine Perron. I'm a founder of ARC Mortgage. I'm a mortgage broker, and I'm also certified as a Smith maneuver specialist. My background is project managing, but I've always had a passion for finance and helping homeowners leverage their property to build long-term wealth. Stéphane, I'm going to let you introduce yourself.
Thank you, Martine. Good afternoon, everyone. I'm really excited to be here with Martine, presenting the Smith maneuver. I'm a mortgage specialist as well. I've been in the mortgage industry for almost 10 years now, 25 years in banking and finance. So I've been in business for quite a long time, as you can see by the color of my beard. And we are really excited to introduce you to the Smith maneuver because we love the strategy with Martine. We love it because we love helping our clients getting ahead with their finance and especially getting rid of their mortgage on their primary home.
Yes. So we share that common goal. We're deeply committed to help owners strategize and restructure the way the money is flowing to make it as efficient as possible. And so this is what the meeting's about. So I'm going to see if I can move this thing here. Okay. Turn rental income into a mortgage paying machine with cash damming. Currently, investors, they can face either challenge in regards to, cash flow. And so we're going to review that. We're going to do an introduction of the strategy, which is called cash damming. We're going to go over what are the tax benefit and the wealth building opportunities. And we're going to give you a real life example. Okay, let's start by talking about the challenge that we can face as real estate investors. In BC, and particularly the real estate can be very expensive, and that means most mortgage are quite high. And so for homeowners, when you have your own mortgage, and you also have mortgage on investment properties, it can seem like a lot of debt. And, with the interest that increased recently, I know that a lot of investors have been thinking about maybe selling because the rental income might not be sufficient to cover all the expense on the rental. And so those are the challenge that a few can be facing. But today there's a strategy I want to talk about to turn these obstacles into opportunities. Stéphane, feel free to add if you...
Yeah, to illustrate what you said, today with the current interest rates, if you buy a house with a mortgage of $500,000, let's say you go with 25 years amortization, how much do you think this purchase is going to cost you in interest? A lot of money.
Yeah.
A lot of money. So you buy a house with a $500,000 mortgage, you will end up paying $330,000 in interest only over the course of the 25 years. So that's the first thing. The second thing is the income you will need in order to pay that mortgage is $1.2 million before tax. So as you can see with those numbers, you will need a lot of money in order to be able to pay down your mortgage. So this is where you need to think about a strategy, Smith maneuver, which will help you to pay your mortgage faster and pay less interest to the bank.
That's right. You know, in Canada, the usual approach that we're been taught, you know, since we're younger, is to have no debt. And so typically people are taught to pay off their mortgage first and to then start saving. And the funny thing is, you know, as soon as you get a mortgage, if you stop making a payment, the bank's going to call you right away. And they're going to ask you, where's my mortgage payment? Where on the other end, if you're not saving for yourself, for your future, for your retirement, nobody's going to call you. Nobody's going to say, hey, Stefan, are you saving for retirement? And so we have this weird approach where we're focusing on paying the mortgage first and then start saving.
Exactly. And you see that today with the average Canadian income in Canada, it's really hard to be able to achieve both, paying down your mortgage, saving for your retirement, because you have all those other expenses, the kids' education, and it's virtually impossible if you just follow the current system to be able to retire with a decent retirement income today. So
yeah, we see it quite often as mortgage brokers, the difficult phone calls with people in their 70s that they ran out of money and they don't know where to take the money. They would like to help their children buy, they would like to help their grandkids, but they ran out of their savings. And that's why we believe that the traditional method, that it's paying your mortgage first and then saving, is actually falling short. And so the Smith maneuver is the basic of what we're going to be talking about. The cash damming, which is for a real estate investor, is an accelerator to that strategy. But it's important to first understand how the strategy works, to understand how you can do the cash damming with your investment property. And the Smith maneuver, there's the basic of it is that while you're paying your mortgage, while you're already committed to that $500,000 mortgage, the principal that you're paying in that payment is going back to you and you can use it right away. You don't have to wait till you're in the 70s and you're lacking money. So what we're doing with this strategy is we're making that dollar that goes towards your mortgage work 3 times. 1, it's paying down the mortgage, the bad debt. 2, it's used to save money for retirement. And 3, you're getting tax deductions. So these benefit happens over the long term of the mortgage, but it can start immediately. So let's see with graphs, how does this work? So to picture it, here we have the $500,000 mortgage. In this scenario, the mortgage payments are $2,200 monthly. As you can see, from that $2,200, a portion is the interest, and that portion you'll never see again. That goes to the bank for lending you the money. On the other hand, you have $940, that's your principal, that belongs to you. And currently, most people don't do anything with it. And that's where the missed opportunity is. Because what you can do when you have the right mortgage product is that that money will be re-advanced into what we call a HELOC, home equity line of credit. In a HELOC, the rates for on the HELOC are the lowest you can find because the HELOC is secure against your home. And now what the opportunity is to take that money available and invest it month after month after month. So during the term of your mortgage, you have money that's being saved and it's not coming out in addition of your mortgage payment. We're using the money that you already committed to and we reinvest your principal.
If I can add something
Yeah.
as well, is the interest on your HELOC is not compounded, it's simple interest. So it's a bit higher usually compared to a mortgage rate, but in the end, a mortgage rate will cost you more because it's compounded interest.
And it's a very good point, Stephen, because not only that interest compounds, right, but it also compounds on the bigger chunk. Because the interest is based on the beginning of the mortgage, which is 500,000, where the HELOC rate, even though slightly higher, compounds differently, but mostly it compounds on a smaller amount. The goal of the Smith maneuver is to make your mortgage that was not tax deductible on your principal residence fully tax deductible. And so we're not adding to the debt, we are converting the debt. I just want to check, Stefan, can you see if there's any questions so far, or should we ask a question? Because I don't want to leave the page.
I cannot see any questions so far.
Okay. Can you see if you can ask a question and people can reply? Like, does anybody follow up till here?
Open.
Is there people that can you see if people raise their hand? Okay, I see Mariana.
I
View.
cannot see.
Cannot
see them.
Okay, let's see if it can allow you to talk. Mariana, can you try to see if you can talk? Maybe I'll stop sharing just for that moment.
Oh.
Q&A.
Emily.
Does this apply to is this a property? Emily, great question. So we haven't gone into the rental portion yet. Investment properties are already tax deductible, so that's good. But what's important here is to understand that the mortgage on your principal residence is usually not tax deductible. And you could do this strategy whether you have investment properties or not. That's kind of the basic. When you have an investment properties, we're going to show you later on how you can accelerate that debt conversion.
But if you apply to purchase,
yes, you could do it on the purchase.
Or on the purchase of a new investment property, yes. 100% you will be able to do it.
Okay. And Lindsay asked, can you explain what the investment rates needs to be in offer to offset the mortgage rate? Thank you, Lindsay. It's a great question as well. This strategy is not it's not a short-term strategy. So it's not something like, okay, tomorrow you invest, you know, and you got to make the same amount that this, the HELOC. It's a long-term strategy. And we can't just look at the money that's made on the savings versus the money made on the money paid on the HELOC, because the interest rate that is accumulated on the HELOC is tax deductible. So truly, it doesn't have to be the same for the strategy to make sense. If you do the strategy for 7 years or more, you will have benefit because you have money growing and that money is compounding. And the money that's compounding on the HELOC is tax deductible. And so year after year, your savings are going to be bigger. So if there's no other questions, I'll go back to sharing my screen. Okay. Here it comes. Smith maneuver, convert your mortgage into a 100% tax deductible mortgage while generating valuable and increasing tax deduction, eliminate expensive mortgage faster, and invest money that otherwise would have not been available. Now, we're getting to the fun part. This is an accelerator of the Smith maneuver. So we talked about the typical Canadian approach, which is usually you pay off your mortgage and then you save money. Well, there's also a typical approach when it comes to rental properties. Usually what happens in homeowner is going to have their principal residence, they have their mortgage, they're paying their mortgage, and then they have investment property, they're getting rental income, they're using the rental income to cover for the rental expense, right? So as such as the mortgage on investment property, strata fees, municipal tax, insurance, right? There's a bunch of expense that come to the rental. Sometimes the rental is cash flow positive and there's money left that the person can use. Either they can save it or they can use it to pay their own mortgage. Or sometimes the cash flow is negative where people have to come up with more money to cover for the rental expense. That's the typical. The Smith maneuver in cash damming, there's no new money involved, but we're restructuring this flow. Okay, and that is a bit complex. So I didn't create those charts. I'm using the charts that there's someone that created the strategy, Fraser. The son, Robinson Smith, took over and he's done a book that you can get, and I'm reusing the charts from the book. So how is the cash damming different than the usual typical approach? Is that you have here the mortgage on your principal residence. So as we know, you already committed to this, right? So every month you're paying the mortgage payment. Now you also have the $3,000 here. And here they make it super easy where you actually have $3,000 of rental income and $3,000 a month of rental expense, which is not always the case, but to make it as simple as possible. And so what you do is, in addition to make your mortgage payment, you're going to do a prepayment every single month of the rental income onto your mortgage on your principal residence. So now you paid your mortgage principal residence from your own money, and you're making a prepayment on your mortgage on your principal residence with the rental income. And now the question is like, well, hold on a second. If I put the $3,000 that I receive from my rental on my property, how am I going to pay the rental expense? And it's a really good question. Because you made a prepayment on your mortgage, in addition of the $940 that we already saw that became available from your own money, you have now $3,000 that's also available on your line of credit. And that's what you're going to use. So you're going to use your line of credit to pay the expense on the investment property. Why would you do that? Well, because that mortgage on your principal resident, that portion is not tax deductible. And so we want to get rid of it as fast as possible. By doing the prepayment on your mortgage, you could pay a mortgage as fast as 10 years. So you could save 20 years of amortization while still getting the tax benefit of owning a rental property, and get additional tax benefit here because you're using your line of credit attached to your home, which is tax deductible. Do you want to add on, Stefan, or should I go through my live example?
Go ahead. I just want to maybe emphasize that in order for the cash flow dam strategy to work, you actually need to have a mortgage on your primary home. You
Yes.
cannot just have an investment property with a mortgage and using the cash flow dam strategy. This is not going to work. It only works if you have a mortgage on both properties and if you're using the HELOC on your primary home to do the cash flow dam strategy.
That's right.
Right.
That's right. Because if you don't have a mortgage on your principal residence, then you already have no bad debt, because a mortgage on an investment property is already tax deductible and it's already put in a good debt section. And so the rental income can just be used for that because there's nothing to convert on your principal residence. How does this work? So here's a real example. I were working with John and Sylvia. They had one principal residence and they had two investment properties. Their home was worth about 1.8 million. The mortgage balance on it was 687. And they wanted to pay this as fast as possible. And they were thinking about selling an investment property. So I said, hey, this is what I do. I can restructure the cash flow and help you pay your mortgage faster. So what we do is we look at everything. We look at all the details for each properties. And so with the new mortgage, with they were at renewal. And so what we did is we started the new mortgage, new rate. This is their monthly payment, $42.19. And that was something they were comfortable paying. They're like, yep, this is perfect. This aligned with what we can do. And when I did the strategy, the prime was 1% higher. So just to show you that it worked even with that rate. The two investment properties were cash flow positive, not by much, but they were. And this strategy would have worked even if it was not, but it was just good that it was cash flow positive for them. So you can see the rental income here is $2,200 a month, and here is $2,600 a month. So together, 48. I should have put another page. Okay, so what we did, right? So he's comfortable putting the $42.19 a month. Now, what we do is, in addition to that $42.19 a month, he's gonna do a prepayment on his mortgage of $4,800. What does that do, right? That means that John and Sylvia are going to be paying, so the mortgage is the blue line, reduced amortization. So it was starting, sorry, I'm going to move this here, somewhere here. Typically, they would have paid it in 20 years. That was what they were supposed to, that was the amortization. But because they're going to do the cash damming, they're going to pay the mortgage, the fixed portion, in 7 years. So they're saving 13 years on the mortgage. That's the bad debt. So for the next 7 years, by doing this strategy, they're going to have no more bad debt. And their investment portfolio is going to grow because they have more money, because the investment properties are cash flow positive. They're going to have money left to invest from the rental income. So not only they're paying everything, the expense on the investment properties, but they're also saving money at the same time. For them, it was saving on 13 years of amortization on the principal residence, which represent I didn't put the interest in saving, I should have. And they also have an estimated of $460,000 tax benefit from doing this strategy. Anything you want to add to this, Stefan?
No,
I don't know if I went too fast.
no, it's good. I mean, when you see the graph, it's pretty amazing that your mortgage has been paid so fast. Basically, what those clients are going to do, they are going to develop their payments on the principal residence. They are going to use the tax refund, which is a tax-free check, basically, right, that you receive from CRA, put it back as well as a lump sum on the mortgage, on the principal residence. So you can imagine and you can understand now why the mortgage balance and the mortgage amortization is going down so fast.
Yes.
At the same time, what you need to keep in mind is that what you're doing here is that you're replacing your bad debt by a good debt, which is the HELOC debt with tax deductible interest. So your level of debt, even though you've paid down your mortgage faster, your level of debt hasn't changed. So this is important to keep in mind. But at the end of the process, when they've paid down their mortgage completely, they've at the same time saved the same amount of money plus the rate of return in their investment portfolio, right? So then at that point in time, you have two options. You can keep the good debt on your home through the HELOC and continue to benefit from the tax deduction on your tax return. Or you could take out the funds you've invested in your portfolio and pay completely down the balance on the HELOC and completely get rid of your debts.
Absolutely.
Yeah.
So I just did a quick calculation on so if the mortgage stayed at the same rate, right? The saving in amortization equals to 650,000, right? So if they didn't want to keep the debt, right, and they don't want to necessarily wait till the end of the strategy to pay it off, they could keep up onto paying the 4219, and that would goes directly to the HELOC, which would bring the balance down over time. So different strategies when it comes to what to do with the HELOC and the financial goals. We like to work with a wealth advisor to have like a full picture. We can help with the mortgage, we can help to implement the strategy, but the wealth advisor are really the people that are going to make sure that it matches your goals. I see some question here. Lindsay, my understanding is that the higher the tax bracket the individual is in, the more beneficial this method is. Is that correct? And if you're in the lower bracket, the benefit are reduced. I think the tax benefit is not necessarily the bigger advantage of the strategy. It's a nice to have, but I think the main benefit of the strategy is to cut down that amortization really, really fast without taking more money out of your pocket.
Yeah. Basically, it's true. If you are in a higher tax bracket, it will be more beneficial. But if you're in a lower tax bracket, you can still benefit from the strategy 100% sure. Because as you can see, you're paying down your mortgage faster, and this is what's important, basically.
Yeah.
So whether you have a high income or lower income, you can still go ahead and do the strategy.
And I have a second question from Emily. Can you clarify again? So the HELOC is going to pay for the rental expense. So interest on the HELOC is a tax deductible expense. Is this correct? As long as the HELOC is used for that purpose or investment, right? If there's enough room, that will be tax deductible. there's a CRA rule. I can't remember the exact number. We have accountants we work with as well. There's a CRA rules that when you borrow to invest, the interest on the loan is tax deductible, and that's what we're doing here. How does the CRA refund comes into play is that year after year, when you file your taxes, we can show you with the mortgage statements how much you paid in interest into the HELOC, and then you add that into your when you file your taxes, and that's when you're going to get the tax refund. Is there any other questions? Oh, Emily, thank you. My pleasure. Okay, now we talked about the fun stuff, but you know, most people have concern when it comes into implementing so those strategies. The usual questions I get is, what if rental expense exceed rental income? Well, it's a great question, but as we show, when you pay your mortgage on your principal residence without thinking about the investment properties, there was a part there that was principal already. So there's already money that's going to be available in the HELOC, whether you do the cash damming or not. So if your property is cash flow negative, first of all, you already are paying out of pocket to cover those expenses. So the cash damming might help you to reduce that money that you're coming out of your pocket because there's principal available from the mortgage payment that you already are doing. I don't know if there's a better way to explain this.
No, you know what's important to remember with the Smith maneuver strategy, with all, by the way, with all the strategies you can use, I think you have up to 6 or 7 strategies you can use with the Smith maneuver. With most of them, you are not required to come up with any additional cash from your own pocket. Your cash flow, your monthly cash flow stays the same, basically.
Yeah, that's right.
Right.
Yeah. Is this compliant with CRA regulation? Yes, it is. As long as you do it the way we show you how to do it. It's not something I would try to do on my own. I just saw another questions coming. I want to put a case study in here. Okay. Let me go. I'm going to do the case study right after I'm finishing with that slide. How much administration and time would this require? Because, you know, we're all busy with our life already. When you work with people that have the expertise and they know how to do the plan, this could be as easy as in low time as 5 minutes a month. If you try to do it on your own because you believe you understand the strategy, you could really put yourself in a bad situation. It could require a lot more time. Okay, so I'm going to answer that question. So, Stefan, there's another easy question. Does it matter if the principal residence is under one spouse and the rental property is under the other spouse? Great question, Emily. I would want to double check with my accountant to give you a perfect answer.
Yeah, this is where it could become complicated. I don't think it matters, at least for the tax refund portion. Then I think, yeah, you're right, Martin. It needs to be double checked with an accountant to be sure.
Yeah, I have an anonymous attendee and it asking me to my accountant is Monique. I have her. Do you have her email, Andy, Stefan, that you could put in the chat?
Yeah, I think so.
Okay. All right. So I have a case study to go through. So here it is. I have a HELOC of 150,000 already, and a mortgage of initially 416. That's currently at 361 on 30 years amortization. Household income is 150. The HELOC is with TD. For what is worth, the initial year of the mortgage was 2020, so your renewal is coming up soon. Best way to maximize with this. Yeah, so great case study. So is the HELOC utilized, or is it at zero balance? HELOC is fully available. Great. So it sounds to me that you already have the right mortgage product. So you might not need to change mortgage product, right? You could probably stay where you are. Having this HELOC available is awesome, because if you were cash flow negative, you would have room enough to pay for the rental expense. TD is not a bad lender to do the strategy with. You definitely could pay your mortgage super fast if you have an investment property by just restructuring the cash flow of investment property. The investment property doesn't need to have a HELOC. To be exact, we could definitely have a chat. There's something you can do. Do you have any further questions for me on your scenario? It's funny to talk by chat. Lots. Okay, well, I think we might want to book a one-to-one to make it to see how it would apply to you. So that brings me to what's the next step? Book a consultation to assess if you qualify. So what we do is the consultation is free. And during that call, we ask you a bunch of questions and we run the numbers with you to see how much you would actually save in amortization, income tax. It's an estimate. We don't give you a plan then, but we just say, hey, with the strategy, this is how much you could save. We see if you qualify for it. And if it's the right thing that you want to do, then we move on with doing the plan for you. We usually charge 5,000. This is kind of like a high level number because it depends on how many investment properties you have and the complexity of the file and if we're doing the mortgage or not. Because we do get paid when we fund a mortgage ourselves, but if you prefer keeping your mortgage and not touching it, but we can still do the strategy, then we would charge for our time. And I think the best way to book an appointment would be to reach out to our email. So we could put both our email in the chat. Any other questions we can help with? I don't see. I can't see the chat, just for your information. Yeah, I can see it though.
Yeah, okay.
Yeah, I realized there's
Um,
a lot more functionality on the webinars than just like a traditional Zoom. So our email, so we're both certified with the strategy. And that's our emails. Oh, I can't see the chat. Okay, so maybe people can see my screen and the two emails I just posted. Is your fee you mentioned deductible through the Smith maneuver?
No, I
No.
would say no, but the investment is low compared to what you can save,
Yeah.
right? You can still put it on your HELOC if you can have at least 2 HELOC segments, because what you will need to do for your accountant will need to be able to clearly separate what belongs to the Smith maneuver and what doesn't belong to the Smith maneuver. So that's why you need to be on the right product with the lenders, because you want to be able to track correctly all the debits and credits on your HELOC and accounts in order to be able to track everything correctly for CRA, basically.
Yes. I love those questions. Any more questions? Thank you. You're welcome. Yeah, it's not easy in the webinar to like really explain exactly how it's going to apply for each of you, but there's like tremendous savings when you investment properties. And beside that 5,000 consultation fee, usually it's just reworking the workflow for you. And depending on if you're cash flow positive, negative, that's like where the plans come into effect to see what's the best way to do this. We work with you to make sure that the monthly payments are going to make sense for you. And yeah.
We have direct access to Robinson Smith, who is the son of the guy who invented the Smith maneuver back in the 80s. So Fraser Smith is not with us anymore, but his son Robinson is 100% working on improving the materials and all the documentation about the Smith maneuver. His book is a great introduction to the strategy. And so we have access to a lot of things through Robinson Smith. We meet him via Zoom once a week, to discuss business case, to discuss different situations, to discuss different options out there in the market in terms of mortgages. So we really have access to all those resources to help our clients the best way we could.
Mm-hmm. And there's another question that was asked: in what kind of property might be available to buy an investment property? That's a great question. We're not realtors, right? We're doing the mortgage, but we do work very closely with great realtors that we can refer to you, that can help you find a property that would make sense with the strategy. I think the best thing to do first is to find out what you would qualify for, how much it would cost, so you can see what it would look like for you. And that way you have the exact budget when you're going to look for a property to buy. And we have realtors in all province of Canada. All right. I think that's gonna be it.
Awesome.
Okay, so once I'm gonna try to see who joined. If your email, once the recording is done and edit, I'm gonna send it to the people that attend so you can have it. And if you have anybody that you're thinking, oh man, I know this person was telling me that their investment property is not doing well, they were thinking of selling, please refer them to us, because we might be able to help so they don't have to sell. Or if they have to sell, we have realtors we can refer it to. Awesome. Well, thank you so much and have a awesome day, everyone.
Thank you, everyone. Have a nice weekend.
Bye now.
Bye.